Okay, welcome everyone. This is Jeff here with FX Mindshift, and today we're doing a simple guide to trading the Mnw patterns. Okay, you guys don't want to be just trading any old Mnws that you see on the charts. Okay, so today what we're going to do is we're going to teach you how to find the correct Mnws to take, and make sure that you're following the correct entry rules for taking these trades. Okay. So let's get started here. The first thing that we're going to talk about is the importance of the Mnw patterns. And basically what they are is, the reversal footprint of the market makers. Okay, so when you see an M or a W pattern forming on the chart, it's usually a good indication that they're looking to reverse the cycle and take it back up or down the other way, right? So they're found usually at the high of the day and the low of the day. Okay, that's where I want you guys to focus on taking these patterns. You'll see it with some chart examples of how we do that. Okay, they form the intraday anchors for continuation trades. Okay, so if you had some setups, continuation setups that you wanted to take, you wanted to make sure that they were in line with the Mnw patterns, as these form anchors for those trades. Okay, this is where the higher level longs and lower level shorts will be trapped. Okay, so like in an example, like an M structure, these buyers at the top of the M's are trapped, right? The market makers have induced the buyers to go long, and then when you see that M, that's them reversing it on them and taking those trades away from them, getting them in drawdown or hitting their stop losses and reversing the trades. Okay. When the market makers are done collecting contracts, what they're going to do is they'll shift the zone with a shift candle. Okay, and I'll show examples of that on the charts as well. But it's generally like a larger candle that you'll see is they'll shift out of the zone, and then that will usually be the initiation of the reversal. Okay, the pattern will tell us the direction or bias for the session of the day. Okay, and that's kind of going in line with continuation trades and things like that. You'll be able to tell which direction the session will be going for the remainder of the session of the day, based on the the anchors and the M's and W's at those points. Okay. Now, what are the rules for the Mnw pattern? What are you looking for? Okay, you're going to look for an outside structure. Okay, with a strong or a fast candle close above or below the 13 EMA. This is going to be your first leg. Okay, now if you don't know what an outside structure is, I'm going to show you an example of that on a chart in a minute. So stay with me, okay? Price will then go back above or below the EMA. Okay, and they're going to create the apex of the nadir, which is kind of like the middle of the structure. Okay, and then they'll go back and they'll form the second leg. Okay, so you'll see that on the chart as well. The second leg with a nameable candle pattern, okay, something like railroad tracks or an evening star, okay, that's going to allow you for getting an earlier entry, okay, possibly. But if you don't have a nameable pattern for your second leg, the signal is going to be the shift candle, okay, when you see that shift candle form. All right, and that shift candle is approximately 12 to 15 pips on pairs with an ADR greater than 100. Okay, and usually around 10 pips or less with, about 10 pips with pairs ADR less than 100. Okay, I'll show you that also on the chart. And then one thing that you can do is if you want to wait for a 1/3 pullback on that shift candle, you can get a discounted entry and a tighter stop loss for that trade. Okay. All right. What are the entry rules for taking the trade? Okay, so we want a second leg candle close. Okay, above or below the 13 EMA, okay, after the shift candle. All right. The exception to that is if you have a second leg nameable pattern closing after the candle. If it doesn't close above or below the 13 EMA, you can just take the entry based on that candle pattern, okay, because it's a strong enough signal to take if you have a nameable leg candle pattern close. Okay. You also want TDI confirmation. Okay, and that is you want to see the RSI crossing over the signal line. Okay, if it's a sell, you want to see it crossing over and down, and if it's a buy, you want to see it crossing over and up. Okay, you want it to be above or below the market baseline, obviously depending on if it's a buy or a sell. All right, so let's take a look at some chart examples, and I'll show you exactly what I'm talking about. Okay, so here we have a EuroCAD example. Okay, this is a W. 3 pushes with a second leg nameable pattern. Okay, so this is our Asian session. Okay, this Asian session box there, you can see the accumulation phase. Okay, and then what happens after the Asian session? They break out of the box. They give you 3 swipes to the low, 1, 2, 3. Okay, and then they create this outside structure. Okay, so this is an outside structure, and that's your first leg. What that means is you can see how the candles don't pass this. You know, they don't go below this after this structure is made. So this is the outside structure and the first leg. Okay, then they go above the 13 EMA. Okay, make this apex of the nadir, right? This middle part, right? And then they come back down below it, below the 13 EMA, and then they close back above again. Okay, and when they close back up above again, that is your second leg confirmed. Okay, and now here for this particular example, we have a nameable candlestick pattern, which are railroad tracks. Okay, so you have a second leg nameable pattern. You take your entry there. Okay, your stop loss goes below the low of the day. Okay, down here, and then that's your entry. Okay, we have a TDI confirmation here. All right, you have the RSI crossing above the signal line, okay, and above the market baseline, which is this bold yellow line here. All right, and second leg nameable pattern with a candlestick close above the 13 EMA. That's your entry. Okay, now if you did not have a second leg nameable pattern here, what you would have to do is this candle here would represent your shift candle. Okay, it's approximately a 10 pip candle, 12 pip candle. And it's a shift out of the zone. Okay, this is the signal that you're going to get, basically, that the market maker is going to moving out of this range and they're about to reverse. Okay, so as you can see, all right. And if you took this trade and you held it, you would have gotten 60 pips, up here to this point, or if you even held it longer, you could have gotten 100 pips. Okay, so second leg W. EuroCAD with 3 pushes out of the Asian box. Okay, second leg nameable pattern with all our confirmations. Okay, let's look at another example. Okay, this is a triple top, okay, M structure with a second leg nameable pattern. Okay, we have our Asian session. Okay, Asian box range. They break out of the box down here. Okay, normally this would be your first leg for W. Okay, but they never came back and gave you a second leg. Okay, so this is not a W trade, right? Instead, they come up above. Okay, they create this first leg. Okay, and then they give you another hit to the high. Okay, so they create this first leg, they make this high. This is where you kind of want to draw a box, okay, to kind of show yourself, okay, they've made it to this high point. Okay, and then they reverse from there. Now they came back to the high again. Okay, and reversed back again. So this area should be an area of interest to you. Okay, because they come back to the high and they don't break it, right? So this could possibly be, the reversal at this point. But you can see here how this this first leg, actually never closed below the 13 EMA. Okay, so technically, this isn't really your second leg and this your first leg. This whole thing really is your first leg. Okay, so don't see this as a second leg and then say, okay, I'm going to short this here because this actually isn't the second leg. This is the first leg. It doesn't close below the 13 until we get to here, and you can see they shot it right back up. Okay, to the high, but not taking out the high. Okay, and then they give you a second leg railroad track nameable pattern. Okay, this is where your entry is. Okay, and it also closes below the 13. You're also going to have your TDI confirmation. You can see here RSI line is below this signal line, crosses down below the signal line and below the market baseline. Okay, and another confluence to boot you get is the Rsi Divergence. Okay, you can see how this peak here and this peak here is lower, going from high to low, but you can see here it's kind of a straight line, right? So when the candles show a straight across movement, but the RSI is showing a downward movement, okay, or even better, when it's showing an upward movement on the chart, but it's showing a downward movement on your RSI, that's called divergence, and that's another confluence, another confirmation that this trade is likely going to go down in reverse. Okay, so as you can see here, that's your entry. You take your entry there, a nice 35 pip trade, right down to this marker here. Okay, so you can see the kind of the flow of what the market makers are doing. Okay, out of the Asian session accumulation, they induce people to go short here. Okay, so a lot of shorts are trapped here, short sellers, people thinking that this is a breakout. All right, and what they do is they take that away, right? And when they do that, they reverse up here, and they create this, you know, these long fast candles, right? And induce buyers. Now they're inducing buyers the other way. They're saying, okay, this is a buy, right? All these people seeing these candles are saying buy, 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 and then what do? They take it back, right? And now all the longs are trapped up here. Okay, they take it back, then they bring it back up again, a second inducement, right? Trap some more buyers, take it down, bring it back up a third time with a nice big, you know, fast candle like this, right? A big bullish candle. When you see that on the chart, you know, never mind this other stuff here, but when you see that candle form, you know, you're probably thinking as a retail trader, okay, I'm going to buy this now. It's been, you know, it's been bouncing off this support, right? Quote unquote support, and now it's, you know, going long. I'm going to take this buy. Okay, so 3 different times where market makers are trapping the longs here, and then they take it down in one big candle, right? One swift motion, and you know, all that money is in their pockets now. Okay, so that's the behavior, that's the pattern that you're looking for in the charts when you're looking for M's and W's. Okay, all right, let's look at another example. So sometimes what you want to do is you want to wait for the price to clear the EMAs. Okay, so what do I mean by that? Let's take a look here. All right, so we have our Asian session box, okay, over here, right? And we got to break out to the high of the day, which creates the first leg, okay? I drew my box here. You see all these wicks here, right? That's a telltale signal. You see these wicks, okay, hitting the high and rejecting, hitting the high and rejecting. Okay, these are the market makers hitting the stop hunts, right? Stop hunting, hitting the stop losses, taking these buyers out, right? Creates the first leg, closes below the 13 EMA, creates the apex, moves up, creates the second leg, closes down below again, and that's your second leg confirmed at the close of this candle. Okay, closes below the 13 EMA. However, okay, you have a 50 EMA right below that. Okay, so the distance between this candle close and this candle, or this EMA, is really close. Okay, and not knowing what's going on, you know, not knowing this part of the chart because we know what happens, but not knowing what's going to happen, you don't want to be taking your entry at this point because you're too close to the EMA. Okay, it could bounce off this EMA and you know, rocket back up for all we know. We don't know that, right? So the better trade would be to wait for it to clear the EMA, okay? And once you do that, then you're safe to take the trade, okay? So your stop loss goes above here, you know, above the high, okay? And you can also see the TDI confirmation at that point is RSI is below the signal line, below the market baseline. There's a nice big angle of separation, okay? That is your entry, the correct entry to take the trade at. Okay, you could take it here, but you can see here the RSI was below the signal line, but was kind of sitting right on top of the market baseline, not yet crossed below. So that is also another reason why you just don't know at that point what's going to happen with the price. Okay, it could just bounce right off this and take off. So this is a better confirmation, a safer entry, and you can see here it gave a nice result. Okay, 30 pips if you held it down here. If you if you held it through the pullback, okay, you made a nice 50 pips if it came down here. Okay, all right, now one more example. Okay, so we have an M pattern and the second leg is higher. Okay, because sometimes the second leg is higher, but like I said, what I want to show you guys is being able to see the divergence on the charts. Okay, so take a look at the TDI here. We have this peak being higher than the second peak, right? And we have a kind of slope downward, but on the chart you're going to see it go up, right? See this? So the second leg can be higher in this case. If you see divergence on the chart and you have all your entry conditions met, that's a great trade, okay? Especially also you have this 200 EMA bounce, okay? So it's trapping, the people that are taking these trades, right? Breaking out above the EMA. I can guarantee you there's people that trade these, put their pending orders above these EMAs, and if the candle closes above them, they take those trades long. Okay, market makers know that as well. Okay, and that's what they do. They'll trap you. The people that are trading these EMAs, they'll trap those orders, and they'll take those away. They'll hit the stops, right, and they'll reinduce again, right, they'll hit, and then they'll hit the stops, and then they'll reverse, and they'll take it all away. Okay, so from start to finish, let's take a look at this. So we have our Asian session, right, break out of the Asian session, inducing sellers to go short, okay, induce, right, and then they whip it back up, okay. They trap the longs now. They're going fast candles, inducing long buyers, okay. So once they do that, they trap the buyers. Now hit the stops in the buyers. Then they go back up again, induce more buyers, come back down. Here's your shift candle, right? Closes below all the EMAs, closes below the 13 EMA, okay. You have your TDI confirmation, market below the market baseline, crossing below the signal line. Nice big angle of separation there, okay. And there's your entry for the M on the second leg, okay. And then you held the trade, you got 40 pips if you held down to this point here, and then another 20 pips if you held the pullback and got 60 pips, okay. How do you know when to hold for the pullback? A good trick that I use for trade management is I use the 13 EMA. Okay, so it's good to see if the trade, or if the price rather, is closing above or below the EMA, the 13 EMA, and then if it isn't, you can just hold the trade. See, it comes close to this to the 13, but it doesn't actually close above, rejects, and then it comes back down. Okay, doesn't really reverse until it gets up to here, where you can see the first close of the EMA is at this candle. So if you were holding this trade down here at 40 pips, you could have taken your profit at 40 pips. You could have held and got 60 pips. But if you continue to hold and you saw that the price closed above the 13 EMA here, you could have got out and still made 40 pips. Okay, so that's a good way for to manage your trades, to know when you should exit and when you should keep holding. Okay. So I want you guys to look for strong M and Ws, okay? Look for M's and Ws where you see price moving, fast, strong candles moving up, and then, the market makers taking that away and moving back down. So when you see that strong, up and down motion, right, the trapping motion that the market makers do, that's usually a good indication of, of a reversal. Okay, you don't want to be trading these, weak-looking M's that kind of dribble along, right? And the smallish candles, okay, not really giving you a good size shift candle when they take it to the second leg. Okay, those are kind of usually trouble. Okay, so you want to look for these types of M's and W's, okay, where they have the fast move down or below to induce the traders to take the trade in the wrong direction, and then they whip it back, right? That's what you're looking for. Okay, so look for the strong M's and W's on the charts. All right, guys. Patience and consistency is very huge when you're looking for these M's and W's. Okay, like I said, you don't want to just be taking any old M and W. Okay, be very patient when you're waiting for your setups. Okay, look for all your rules to be met. But once you do have all your rules met, don't be afraid to take the trade. Okay, don't be afraid to pull the trigger. Okay, understand that not all setups will work out. But that's why you have a stop loss in place with proper risk management, okay? And our stop losses are usually pretty tight, okay? You can get a nice risk reward out of those trades, and just follow your trade plan and, trust your analysis and let the trades play out, okay? Practice this on demo until you can see consistency, all right? And in time, you're gonna be able to tell a good setup from a bad one just by glancing at the chart. Okay, and that also goes in line with things like looking for the strong M's and W's and things like that. You're just going to be able to tell at a glance, oh, this is probably a good trade, right? This is probably going to come, hit my take profit, right? You'll just be able to tell, but that takes time and practice, right? And that takes chart time, basically experience, right? And then you'll be able to start seeing consistency. And once you start seeing consistency on a demo, then you can think about moving on to a live account. Okay. So that's what you want to do. Aim for 30 pips, okay, and one good setup every day, okay. That's really all you need, okay. And then you can make a nice consistent income from this, just from this knowledge alone, okay. Not just just trading M's and W's. Forget about all the other stuff, right? All the other continuation trades and the different types of trades that you can learn from the market maker method. Just the M's and W's really can make you a nice consistent income. If you just focus on one good setup and 30 pips a day, okay? And I'm going to show you that right now as an example, okay? You watch one pair a day, okay, just one pair, okay, and you go for 30 pips a day, and that's a target of 150 pips a week, 600 pips a month, okay. Now if you traded a 0.1 lot size, okay, a mini lot, right, that would be about $600 profit in a month, okay. Now it's not, nothing, too big, but it's also not, chump change either, right? $600 a month, that could help you do a lot of things. Maybe pay for some bills, pay for groceries, right? Gas for your car, whatever, right? It's just an extra nice little side income that you make for yourself from just watching one pair a day, okay, and just looking for one good setup and catching 30 pips, okay? You do that every day for a month, you get $600. And then let's take it down to, take it up to 2 pairs a day now, okay? If you master that and you get comfortable with it, now you can move up to 2 pairs, okay? Now you're catching 60 pips a day, 300 pips a week, and 1,200 pips a month, okay? That's $1,200 in your pocket now, okay, for doing the same work, really, okay? Not really changing much. You're just looking, you're adding a pair to your repertoire, but really it's not that much more extra work that you're doing, right? Let's go up further, right? Now you're watching 3 pairs, okay, 90 pips a day, $1,800 a month, okay, and then 4 pairs a day, 120 pips and $2,400 a month, okay. I mean, once you get proficient at this, you can do that, right? You can move up, you can watch more pairs, you can catch more setups, and you're just looking for that one good setup every day, okay? Just one is all you need, 30 pips a day. And look at this, watching 4 pairs, you catch 120 pips, 2,400 pips in a month is $2,400, and that's only trading a mini lot, right? 0.1 lot. Some people work a full-time job for this, right? So let's take an example. The great thing about Forex is you don't have to do more work. All you got to do is just increase your lot size, right? When you're able to increase your balance, and obviously you're gonna put up the appropriate risk along with it, okay? You're not just going to up your lot sizes, for no reason, but you're growing your account, you can up your lot size, okay? If you can trade a 0.5 lot size now for doing the same amount of work, okay, catching 30 pips a day on just one setup, you can make $3,000 profit a month, okay? 2 pairs, you're making $6,000 profit a month. 3 pairs, you're making $9,000 a month. And if you're trading 4 pairs, you can make $12,000 a month, okay? Just for trading half a standard lot, okay, 0.5 lots, okay, and you're doing the same amount of work, right, as before. You're not changing anything up, right? $12,000, that's over 6 figures in a year, okay? Most people, aspire to make 6 figures a year. You can do that, just by trading 4 pairs a day, catching 30 pips a day, and waiting for that perfect setup, right? Okay, now here's where it gets very interesting, okay? If you can get it up to trading standard lots, okay, 1.0 lot sizes, just looking at 1 pair, 30 pips a day, okay, you're making $6,000 profit a month. 2 pairs, you're making $12,000. 3 pairs, you're making $18,000, okay, and 4 pairs, you're making $24,000 a month. Now that's just ridiculous income, right? And that's what I said, is great about Forex is you don't have to do extra work. You don't have to work harder. You just have to work smarter and up your lot sizes, right? You grow on your balance. You're making sure that you're associating the proper risk to these lot sizes, of course, okay? But, this is what you can achieve over time with consistency, okay? Trading standard lots and, and making this kind of income. Just trading, 1, 2, 3, 4 pairs a day and looking for 30 pips, okay? There's a lot of traders out there that want big pips and they want, I caught 200 pips, I want, 300 pips. But you really don't need a lot of pips to make a lot of money, okay? You just need consistency, okay, and focus, okay? And 30 pips a day is good enough, okay? That's gonna get you there, all right? So that's it for today's lessons, guys, all right? Hope that was clear and easy to understand. Okay, so thanks a lot. We will see you guys on the next video.